One of your headlines today is peak inflation isn't peak Fed. So that says even if inflation has peaked, do you still expect things to be hawkish from here, particularly this week?
It's nice to see you, Scott. Yes, going into Jackson Hole this week, we think there'll be two key messages. One will be slowing rate of interest rate increases, but we don't see the Fed giving out a timeline for the pivot. That's because even though headline inflation is peaked, there's a lot of sticky components of core inflation like wages and rent, and that's going to make it challenging for the Fed to give out a timeline for where they may pivot and cut interest rates. So we aren't surprised to see the market selling off after the July rally, which was based on the hopes of a Fed pivot in early 2023.
But what do we do from here forward? Is the stock market going back towards the lows, or do you think it can sustain any sort of move, for the next couple of months?
I think the risks are more to the downside. We're going into the fall seasonality period, which usually is weak for markets. We have to worry about employment, which could start to become challenged, the consumer, which is dipping into their saving rates in order to spend. And again, earnings, second quarter earnings overall did look good with double-digit growth, but margins are at peak levels and we have to deal with higher input costs, a stronger dollar that you were just talking about. All of that could be a headwind to earnings going forward. That's what we're facing for the rest of this year.
You still like large cap U.S. equities, though, no?
We like large cap growth stocks because those are less dependent on economic growth. So those can do well in a slowing economy. And then we like energy because of the tight supply situation and producer discipline where they're focusing on returning cash to shareholders. And then looking outside of publics, areas such as private real estate and farmland have CPI escalators built into them and tend to have built-in inflation escalators. All of that is positive. So we're looking outside of just publics for areas where you can benefit from inflation.
I hear you, but if you expect, more inflation, if you expect a hawkish Fed, you must expect higher interest rates. And then the obvious question becomes, how does large cap growth tech respond in kind?
I mean, that's a good point, right? The longer duration stocks can be at risk as interest rates start to increase. We think, though, the market will start to price in some form of a recession, likely a mild one going forward, and that economic growth you'll need those companies that can be more resilient during those periods of growth. So large caps will be the ones that outperform, even as rates continue to creep up, but at a slower pace. So we don't expect this continued 75 meeting after meeting. Next meeting, I think about 50-50 chance at 50 versus 75. And then from there, you slow that pace of rate hikes. You do probably go into some form of a recession, though, and that's what we're worried about is the economic growth and its impact on companies.
Forgive me for jumping on your toes there. I know you guys are always thinking about alternatives, too, at Nuveen, and you have an inflation hedge you like at real assets. Farmland? How do I play that?
Yeah, farmland. Yeah, farmland, we're the largest farmland owner. It's got built-in CPI escalators. Food prices are going up. Land values are going up. Farmland is an area that's very resilient to inflation. It's an area you can look at as opposed to commodities, pure commodities, which may have more demand destruction. And then private real estate, another area of the market that also very similarly has leases with built-in strong cash flows and inflation escalators. Those are two areas we like outside of the public markets.
I look forward to talking to you again soon. Saira, thanks so much. That's Saira.